So as a review, let me just kind of summarize everything we just talked about. When there is a directional bias, a clear trend, 12 to 2 or 4 to 6 on the daily, the rule of thumb then is we want to follow that trend across any time frame if possible. There is a dominant psychology, and to follow that would be the most prudent entry, in my opinion. On those occasions where the trend has a dramatic correction, like we've seen recently, and we want to capitalize on that movement, but we realize it's counter trend, we can utilize the shorter term time frames, the 5, the 15, and the 30, to do that. When there is no overall trend, when there is no bullish or bearish directional bias, when the market is moving on the daily chart sideways, like we saw on the dollar-yen, in this situation, we want to make sure we respect the range highs and range lows, and keep in mind that we don't want to expect within our trading plan that it will be broken. We want to assume that we'll remain within the confines of it until it doesn't, until prices break out. And here too, we want to go to the 5, the 15, the 30-minute time frames because of a lack of directional bias, a lack of longer-term organization and continuation in a certain sentiment and momentum. What will exhaust here is the expectation, because as we come up here, what I'm going to expect is the selling pressure to kick in, and when we get down here, I'm going to expect the buying support to kick in. Simple as that. And that's how I'll operate. Now, when we are so close to the range extremes, in those situations, I'll typically go to the 5-minute. In the situation, in the scenario that we saw on the cable, where we're dealing with a transitional market, this is different than a market that has settled into a chop, like the dollar-yen. The dollar-yen is very much comfortable in that range that it's found. So when we find a market settled into a chop like the dollar-yen, that's a different psychology than one that is transitioning, and that's what we see on the cable here. So in the cable, we have a market that was on the daily chart heading lower, and in that point in time, we were able to say, okay, the psychology is bearish, and it's most likely on bounces that traders will position themselves at resistance, that traders will look for opportunities to sell into a rally. And with that in mind, it gives us clarity in what our strategy was going to be, which is getting short, either at some sort of exhaustion level, perhaps a inside the range fade, or my preference in this situation would be some sort of swing short. But when we have this, which has happened, what has happened? We've not only broken the wave with this break of the 34-period EMA high, we've gone neutral on the grab candles. We lost the consistency and the continuation of the red. The 34 EMA wave angle was never a really smooth, awe-inspiring 4 to 6 o'clock downtrend to begin with. So this has really put the punctuation mark, exclamation mark, I should say, exclamation mark on this transition in psychology, which was bearish to more neutral. This is a market that's kind of making up its mind. That bearish psychology is no longer dominating. This is different than the dollar-yen because, yes, this is more sideways, or it's beginning to adjust to a more sideways market, but I will be very uncomfortable going longer term in terms of the time frame for any kind of trade. On the dollar-yen, because we settled into that chop, it's not that the 60 and 240 were off limits. We just would probably prefer to go short term. Here, I will definitely prefer to go short term because we are still making our minds up. And when we're making our minds up, there's volatility. We haven't gone bullish yet. The market could very well continue back down lower. We haven't established a range yet. The market hasn't settled into a sideways chop. We really don't have a clarity in terms of the trend anymore, but we don't have that nice clarity and that nice, again, that settled down feeling where the yen has just said, okay, I'm in a range and I can live with that. It's settled down within this. We don't have that on the cable. So because of that, for the British pound US dollar right now going forward, I'm going to deal with this and treat it as a transitional market, dealing with high volatility. Yes, it's likely to exhaust. I will acknowledge that there is a higher likelihood that we're going to exhaust at recent highs and lows. So I want to keep that in mind. I want to mark that on my chart. But I definitely want to go on to the shorter term time frames. Okay, so again, the daily chart is helping me determine not only the dominant psychology of these markets, it's helping me determine which time frames I'll be focusing on and which strategies I'll be focusing on for those time frames. Because once you understand the psychology of the daily, I think you have a better idea of what it is that the larger group, the herd, the market participants that we kind of refer to as the herd, we have a better idea of what they're more likely to do. So essentially what I hope you're seeing here is just how important it is that at some point within your analysis, preferably at the early part of your analysis, you are trying to determine what it is that the daily time frame is telling you about the market, and then you are working within that psychology, respecting it really, to set up your trades rather than ignoring the fact that the daily is probably the most well watched. Don't confuse that with the most traded, but certainly the most watched, and it reflects, I think, the broadest and the most dominant psychology in the market. So here we have the Aussie. Well, we're talking about some calm dolls here. The Aussie is squeezing ever so slightly into a very, very large triangle, one that starts with this resistance touch point dating back to the last week of July, and the support touch point dating back to the first week of October. And just you can see the progression of lower highs, higher lows. Ultimately, it's going to squeeze this pattern, continue to squeeze this pattern. Okay, we're favoring the bearish side right now, which we can tell two ways. One, if it's a symmetrical triangle, so you can essentially split this thing in half, like this. Once you split it in half, one thing you can see is which side of the pattern it's favoring. It's certainly favoring for now the bearish, but I can also see that with the dominance of the red grab candles at this moment. Okay, creeping into neutral, but for the most part favoring the lower side. That doesn't essentially mean anything at this point, but when we get into the narrows of the pattern, it will mean more. When we get into where the pattern is really putting a squeeze on price action, it'll mean much, much more. And that's when I'll go ahead and activate an indicator like the moving average of oscillator, which is a MACD histogram based upon the signal line, which is the 0, and I'll look to momentum trade if the pattern holds, if the squeeze continues, because think about something here, and this is something to think about going into next year. If this pattern continues to put a squeeze on the Aussie, a triangle pattern is a congestion to consolidation pattern, whereby the wider part of the pattern is where we see that higher volatility. Sometimes we'll even see trends within that wider part because there's just so much price movement range, right? But as we get into the narrows, that's when we really start talking about the application of this pattern, where it will begin to squeeze price action in that lumpy, say, 2 to 4 o'clock 34 EMA wave angle will begin to smooth into a more flat, into a more sideways 3 o'clock angle. And when that happens, we've seen a drop in the volatility, prices begin to trade in a narrowing range, ever narrowing range, and then we could wait for some sort of momentum breakout or breakdown. Now, obviously, this is a daily chart which has been doing this for months. The same psychology applies to if we were looking at this type of pattern on a 5 or 15-minute time frame. It's still a consolidation to congestion pattern, and that's what I'll look at for the Aussie moving forward. That consolidation to congestion, that drop in volatility, and eventually we may get some sort of breakout or breakdown. But what does this daily chart dictate in terms of what I can do with the intraday time frames? Well, this is another market that is probably more similar. You know, we've seen two kinds of sideways markets so far. We've seen that dollar yen, which is that market that's settled into more of a range. Okay, even though the wave isn't flat, it's settled more into a range, an identifiable range for some time. Okay, versus the adjustment, the volatility that we're likely to see on the cable where it's more transitional. Okay, I'd say the Aussie is going to behave in that more volatile way that we identified, like the cable. This is not necessarily a transitional market. It was back here, you know, when we lost the downtrend, but now it's trying to settle. The settling will be dictated by whether or not the triangle can continue to squeeze. But looking forward into next year, because of what I'm seeing with the daily, with the volatility, with the range still at the wider spectrum of this overall pattern, I will prefer to go short term. I will prefer to focus on the 5, the 15, the 30, and look for opportunities there. Because what we're likely to see are very sharp reversals in the trend. I think let me show you two examples that are happening right now. What I mean by sharp reversals, when you have a market that does not have a dominant directional bias, meaning trending, meaning bullish or bearish, 12 to 2 or 4 to 6, you can have trends on the short-term time frame. So what happens is, rather than seeing a nice consolidation or a little bit of congestion and then a reversal of the prior trend, you'll see these quick transitions. Basically went from an uptrend to a downtrend in short order. And that's very common of a non-trending market, because there is no large group, dominant group, that broad thinking of, oh, this market's in an overall uptrend, or oh, this market's in an overall downtrend. We don't have that. So we get these very quick adjustments or transitions. That's a hallmark of a daily chart that's moving without a dominant directional bias, again, a trend. So because of that, the best way to be able to capitalize on these adjustments, quick adjustments, are on the quicker time frames, the shorter time frames. This is basically a classic wave reversal entry where the swing trade was working nicely, and then this essentially is a failed swing when we pierce the 34 EMA low. And to confirm the entry, I utilize a CCI based on a 20 period. And if we break the 34 period EMA low and accompanying that is at least a negative 100 CCI, that's a wave reversal. Some traders like to use instead the moving average of oscillator, and that would just have to be negative at the time of the breakdown. Okay, either one will do. I think the CCI is a little bit more discerning, but either one will do. And you're going to see these types of entries on the daily chart, on the intraday charts, when the daily is lacking that directional bias. You'll see this type of quick adjustment, quick change in sentiment and momentum, and then in trend, because again, there is no overall psychology that's bullish or bearish. Does that make sense to everybody? So not only is this chart, this daily chart, telling me which time frames to focus on, it's also giving me a clue into the types of behavior that we're going to see. And therefore, if I understand the type of behavior I'm going to see, I can utilize certain strategies with more confidence and be ready with them, be more prepared. That's That's the goal of this analysis. Obviously, nobody knows where the markets are going. Nobody knows how they're going to behave. But our job as traders is just to eliminate certain possibilities, or more so, maybe better speaking, put the spotlight on certain possibilities and say these are more likely than not. However you want to look at it, we're trying to narrow down what we think is the market's next move, and I think the daily chart is a huge part of that.